Let's talk about Chapter 5. You can see it's about automobile and housing decisions, what I think everybody should hopefully find this very relevant. You can see here how this will affect you. I'll just let you read that on your own. But typically just know that a home and a vehicle are typically your first and your largest investments, the biggest ticket items that you'll purchase in your lifetime. So making the right decision clearly is important. Here's the various goals we'll talk about for this particular chapter. And again, I'll let everybody look at the facts and fantasies on their own. So let's go through some things that we would do to make decisions, to make good decisions regarding a purchase. So basic guidelines to wise purchasing decisions. Research a purchase, home or auto. Select what fits your needs or preferences. Buy the item after negotiating the best price and arranging financing on your favorable terms. And then maintain your purchase and make necessary repairs promptly. Exhibit 5.1 would be good to look at regarding that. Okay, so let's talk about buying a car and some research around buying a car. And I have links to a few of these websites in my .usf also, so keep that in mind. Excuse me. So you can see here, Kiplinger's Personal Finance has an online find the right car tool that you can use to help you, find the vehicle that makes sense for you to own. Consumer Reports gives you a lot of information about good deals in terms of what are good used cars to buy, what are good new cars to buy in terms of reliability and features and functionality and things like that. Of course, every vehicle manufacturer's website would have information. Of course, that would not be quite as objective, clearly, as going to an independent website like Consumer Reports or Kiplinger or others. Another good one is kellybluebook.com, kellybluebook.com, and I have that link in the download section of my .usf. So once you've decided on a vehicle, you want to consider how much down payment you can make. And it says here the down payment should not come from your emergency fund. And then what kind of a monthly payment can you afford? And it says that the payment should not be more than 20% of your monthly net income, so your take-home pay. Not your gross pay, your take-home pay. Operating costs go up with the age of your car, clearly, right? The older the car is, the more the cost might be. And then you may also want to consider a hybrid for better mileage, depending on how many miles you'll be driving and so on. And your commute, of course, would probably help you figure out what that is. Should you buy new, used, or nearly new? That would all be questions also. Buying used may allow a luxury car. If you want to buy something fancier, buying a used one, a couple of years old, might be the way to go. Or consider buying a car 2 years old and replacing in 2 years. Buying and selling every 2 years is not for all, but some people kind of like to do that kind of stuff. But so clearly be thinking about that. And then size and body style. What's your family situation? What will be your future needs? How long do you want to own the vehicle once you buy it? All those things come into consideration. And there's no right or wrong answer to a lot of these. A lot of it's a matter of personal preference. Clearly buying used is cheaper than brand new, but then you also have to think about reliability, and we'll be paying more for maintenance and things like that also. So always drive the car, complete your evaluation again, do your homework, do your research, look at those websites, Kiplinger, Consumer Reports, Kelley Blue Book. Make sure that you've got a good handle on, will this vehicle be the one for me? You should also be thinking that, really the sticker price is a suggested retail price. It's not what the price has to be when you sign the deal. Know the cost, and I've already mentioned Kelley Blue Book. The other one that does the same thing, another website that does the same thing as Kelley Blue Book is Edmunds. So go to those websites, look at your vehicle, compare what they say your vehicle's worth versus what the dealer says it's worth. It'll probably almost always be different. Decide your price. Markup is 3 to 4% for cars less than $20,000, and it's 6 to 7% for cars that are worth more than $20,000. For higher priced cars. So just know that's what the markup is. So how much can you talk the dealer down from that markup would be a question to ask yourself. Buying services are available. They could do the following: have arrangement to sell a car at a predetermined price, provide you with bids from local dealers, and place an order with the factory. If you're a member of like a Costco or a Sam's Club, they have some of those services you might want to check into. If you're buying a new vehicle, you might be able to get a deal through them with the manufacturer directly. Then, of course, the question is, should you lease your vehicle? Should you buy it and make a payment knowing that when you're done with the payments that you own the vehicle? Or you could simply just lease the vehicle, and when you're done with the lease terms, you've got a couple of decisions to make. Should you can just walk away from the lease and let the vehicle go, or you can purchase the vehicle too. It says most leases are closed-ended. At the end of the lease, simply return the car. And if it's not abused, basically if it's kept in decent condition and you did not go over your mileage allowance, you just simply walk away, and that's it. Quite often you can get into a lease with a lower down payment also. But the lease payment is based on 4 variables. What's the capitalized cost? Basically, what's the price of the vehicle? What's the forecasted residual value at the end of the lease? Basically, what will the car be worth when the lease is over? Time value of money comes into play, basically the money factor, which is similar to an interest rate on a loan, and the lease term in terms of years. So those 4 things will determine what a vehicle lease would be, what your payment would be. And depending on the leasing company and the dealer, you might not have to put very much money down to get a lease either. Maybe they're okay with a small amount of money down or no money down, or so that might make it more easy to get into or affordable on a month-to-month basis than outright purchase where you have to put some money down and so on. So most leases are 2 to 4 years. Lessee is responsible for insuring and maintaining the car. So lessee is the person who signs the lease and is driving the vehicle. So that person is responsible for insuring the vehicle, and typically you have to provide proof of insurance to the leasing company and do regular maintenance, so as the car needs oil changes and whatever it needs at different mileage points, just making sure that those are taken care of, and keep your documentation so you can show the dealer at the end of the lease that you did all those things. That's important. Most leases have some kind of a purchase option at the end that allows you the ability to buy the vehicle. So if you exercise the option, it really depends on what the residual value is. If it's lower than market value, purchase it. Otherwise, you probably would not purchase it. So you want to compare the residual value, which is in the lease, basically what you'd have to pay the leasing company to walk away with the vehicle. You'd compare that to what the market value is and make a decision from there. So there's some worksheets, and for this chapter is actually 4 worksheets. Really the first 3 are the ones you'll be using though for Cengage. There's 3 Cengage problems for Chapter 5, and so worksheets 1, 2, and 3 are the ones that you will use. But I put them all out there for you to take a look at. You might just want to save these for future use, future personal use at some point also. So basically one of the worksheets is lease or buy, and so it walks you through a series of calculations to figure out, should you lease or buy a vehicle? What's the best option for you? And so it's looking at the initial payment, the down payment, security deposit required, terms of the loan or lease, and so on. So basically just what the payment terms will be, what the interest rate will be, and so on, and calculates basically should you lease it or should you buy it, and just kind of helps you figure that out. So let me show you that worksheet. I've got them open already. So worksheet 5.1, let me get to the right one here. That was 5.3, and oops, there we go. There's 5.1. So here's 5.1, and so automobile lease versus purchase analysis, it says at the top. Just go ahead and plug in the information you need, and it will spit out what you should do, basically once you enter the information. So you'll do one of these for Cengage, so you want to have this worksheet available, kind of just out there for you to work on to do in Cengage. Okay, so it helps you make that decision. So that blue shading is what you're filling in. You won't be necessarily filling in all the blue shades. There'll be some that maybe you don't fill in. Anytime you see a little dot right there, that's a formula. So it just there's just no numbers to calculate the formula, but that's what that will be. Those cells are protected, so you can't overwrite them anyway. Okay, so that is worksheet 5.1. Okay, so that was all about vehicles. Obviously, I went through a lot of their information there fast, but um, really, when it comes to a vehicle, do your homework, do your research, have somebody in your life that you trust help you with the process also, if that's a parent or a family member or whoever that is, or a good friend. um, help. If you're negotiating and you don't feel like doing that on your own, bring somebody with you to help you negotiate. That's very okay. The dealer doesn't care. I promise you it's okay. So just keep in mind, just do your homework, do your research, test drive the vehicle. Don't be afraid to walk away from the dealer if they feel like the dealer is giving you a hard time or not answering your questions or whatever it is. Just don't be afraid to walk away. There's plenty of places to buy a vehicle. So just don't ever feel pressured to buy something that you don't want, and just do your homework and you'll be okay. Okay, let's talk next about housing. Obviously, everybody's very aware there's lots of options when it comes to housing, even before you decide to rent or buy. Um, what kind of housing best suits your needs? Is it a single family, condominium, some kind of a cooperative apartment, rental units, whatever that is, what best meets your needs? So, why would you rent? Clearly, renting is easier in terms of affordability. You don't have to put money down, depending on the apartment or who you're renting from. They might want some money as a deposit down, but you're just signing a lease and making monthly payments. And as long as you make your payments, everything's good. Clearly, you should rent if you're um, not sure where you want to live, if you've taken a job somewhere, but you're not sure if you like the job or will be there very long. Renting allows you to live somewhere without having to make a long-term commitment. Um, Clearly, there's less maintenance when you rent. If you own a home, there's all the lawn, snow removal, keeping up with lots of things inside and out of the house that you're responsible for. If you're renting, if something goes wrong, you just simply call your landlord and say, "This doesn't work. Please fix it." So it's a very different situation. So it's for somebody who's very busy, working a lot, and doesn't have that time, that might be an option also. Potentially, current prices and mortgage rates are unattractive, potentially, and so renting makes more sense. Can invest down payment, earn better return than owning a house, potentially. That's not always the case. It depends where you live with some of these answers. The rent ratio is the ratio of the average housing price to the average annual rent. Provides insight to the relative attractiveness of buying a home versus renting in a given area. And I will just tell you right now, generally, in the vast majority of the country, it probably makes more sense to own versus renting. That's not always the case, clearly, but living in the Midwest like we do, it's very affordable to once you buy a home, your payments will be potentially even less than renting. It's very possible, depending on how much you're borrowing. But interest rates are so low right now that it makes purchasing a home very attractive. The challenging part is in a city like Sioux Falls that's growing so much, getting an entry-level house can be challenging just in terms of finding something that's available or in a location or a floor plan that is desirable to you because they go so fast. So anyway, so Trulia.com, if you have not heard of Trulia.com, if you are beginning to think about real estate, you definitely want to look at Trulia. That will definitely be a website that will help you a lot in terms of finding a place and just helping you educate yourself about the market with wherever you live. This shows you here where it might make more sense to rent versus buying, depending on different metro areas. And you can see the cheaper to buy is the green, and the darker, lighter green, dark green, and so on. So you can kind of just see, a lot of these dots are for metropolitan areas, larger cities. There isn't a dot over South Dakota at all. Anywhere, Minneapolis is the closest, and Omaha also has one. But you can just see that generally in the Midwest, you'll probably discover that buying probably makes the most sense. But you don't want to buy unless you know you're happy living in that community. It's best if you buy a home to live in it for 4 to 5 years, because you want to build up some equity before you sell it, because you have to pay commissions to sell it. and so on. So you typically don't want to buy unless you know you're committed to living at that location for a few years. So there's a worksheet that will help you figure out the renting versus buying, and I mentioned I had that one open. It's worksheet 5.2. So I know it's kind of small to see in the screen, but just open up the Excel and take a look at it. And one of the Cengage problems is about this, renting versus buying. So take a look at that and just make sure that you have a good handle on what that means so you can do this homework problem in Cengage. And we'll talk more about it here. So basically what you're doing is you'll get what your rent costs are. Renter's insurance is fairly inexpensive. I want to highly encourage everybody, if you are renting somewhere, have renter's insurance. It will take care of your personal items, whatever those are, if they are stolen, damaged in a fire, whatever it is. It'll just, those things will be protected. It's very inexpensive. Potentially you're covered through your parents' homeowner's insurance, possibly. Maybe yes, maybe no. You might want to just double check that. But renter's insurance is very inexpensive. So if you're renting, by all means, please get renter's insurance. You know, something happens. In Sioux Falls a couple of years ago, a very large apartment complex caught fire. It seems like you hear that all the time. Something catches fire, and you are insuring your personal items that are damaged. You know, if they're smoke damaged, water damaged, whatever that is, or destroyed in the fire, you know, have insurance to replace those. Your clothing, TVs, electronics, computers, whatever that is that was lost, you now have a way to get that back. So anyway, just that worksheet will help you go through that process of renting versus buying when it comes to making that decision. Now this is the cost of buying, your property tax, your mortgage payments, your insurance on your homeowner's insurance. Now if you have a mortgage, which most of you will, you are required to have insurance, and you should have it anyway, no matter what. Have homeowner's insurance. It's not expensive. Mine is a little over $100 a month. You know, just definitely have it. So if something happens, you can get your house replaced and your personal effects replaced. Maintenance, clearly the newer the home, the lower that maintenance will be. If a home has been newly remodeled and refurbished, you know, that would reduce that also. After tax interest costs, remember that you're getting some tax benefits by owning. Now you get to deduct your property tax and your insurance. I'm sorry, interest, not insurance. So you get some tax savings, so that helps you with that too. But all those things go into play to help you determine if you should rent versus buy. So the benefits from owning, of course, I mentioned that you get to deduct your property tax and your interest on your mortgage. Provides a stable place to live, less likely to move if you own a home. It's a great way to build wealth. It's probably one of the easiest ways to build wealth, especially if you live in the Midwest or a city like Sioux Falls that's growing very steadily. There's a good chance your home will go up in value 3 to 5% per year. It's not, it won't be that amount every year, that range, but just by owning your home, the home prices go up every year, and just so you got a combination of your building equity in your home by paying down your mortgage and just by the market going up. And so that is a way to just basically make money and save money, is by owning a home. So the cost of home ownership, of course, is the down payment. Depending on the bank and the mortgage that you go through, typically most want around 20%. Potentially you can get by with less than that. It just depends. If you have an IRA, an individual retirement account, it's very possible to borrow some money from that account and use that for a part of your down payment. Same with the 401k, it's possible to borrow from that and use those funds for a down payment. So that's allowed. That's very okay. You pay interest on that, of course, but it's a way to tap into your savings and use that to be able to purchase a home. So don't be afraid to do those things. If that helps you get into a home quicker, that's okay. You can do those things. That's allowed. If your down payment is less than 20%, you may be required to buy insurance, what they call it private mortgage insurance, or PMI, which protects the lender if you default. So that's the one downside of not having 20% down, is you might have to pay that PMI on a monthly basis, and it takes a while to get that to go away. So just some things to consider. And so Exhibit 5.7, your chapter, also gives you a big list of closing costs, just things you'll have to pay when it comes to having a home. So just be aware of some of those things also. In computing your mortgage payment, how does that come up? How do we come up with that number? Just know that the PMT function in Excel will do that for you. A financial calculator will do that for you. What's probably even easiest is if you just go to a bank website, and there's all kinds of mortgage calculators, and I've got some links to those under my.usf. So there's all kinds of links there that you can look at to help you figure out what a mortgage payment would be. So in this example, if you're borrowing $180,000 over 360 months, that's basically 12 months times 30 years, and interest rate 6%, that will then give you what your payments are. So the PMT function, either in Excel or in a financial calculator, would give you what your payments are, or what's really easiest with mortgages or websites. So the question always becomes, how much can you afford? How much home can you afford? And the rule of thumb is that about 30% of your gross income, so 30% of your gross income, not net income, gross income, should go into what you can afford for a home. And of course, your lender will help you out with that. So just keep in mind that once you go apply for a mortgage, mortgage lenders will help you understand what you can afford, what they'll give you a loan for. And I would highly suggest that before you go about buying a home and selecting that home, make sure you're pre-approved. It'll just be easier. So especially if a home seller has several offers, and they might be more willing to accept the offer for somebody who's already got the payment, they've got the loan taken care of, they don't have to worry about it. And that would be just one thing to keep in mind in terms of being able to find that home you want, especially with entry-level homes that go really fast. If you've got your ducks in a row and you've got the mortgage company has already approved you for a certain amount, just go out there and buy that home. You don't have to worry about it because you've got it taken care of. And sellers like that, they just know, okay, a seller's already got everything approved versus one who doesn't. I'll go with the one who's got everything approved. That's who I'm going to sell to. So just one thing to consider. Now, keep in mind too, it's more than just your payment, right? So just your mortgage payment is just a part of what you pay a month to have your home. You have to make property tax and insurance payments also. And of course, you'll have to have some money set aside for utilities, maintenance, and so on. So all those things go into play, in terms of snow removal, lawn care, if you're doing those things on your own, hiring somebody, just routine maintenance that needs to happen with any home. All things to keep in mind. And so worksheet 5.3 is the home affordability worksheet, and I've got that one open too. And just kind of walks you through those steps when it comes to home affordability. What are the different costs that you'll have to come up with and keep in mind? And then it'll help you kind of figure out what your monthly payment would be, and then how much money you have to have set aside on a monthly basis to take care of owning your home. So you'll have a Cengage Now problem where you will use this worksheet, so just keep that in mind also. Okay, so let me just close some of these. Okay, and so let's go back here to the PowerPoint. So just keep that in mind. That you'll definitely want to kind of be aware of that worksheet and take a look at the example of the worksheet in your book. So the home buying process I already mentioned, you should go out and have your home mortgage approved. So you know how much home you can buy, and that you are okay making an offer on a home knowing that your bank has already approved you. Definitely do your research on the market. Use an agent. By all means, use an agent. As a home buyer, you're not paying anything for the agent. The home seller pays the commission. So having an agent doesn't cost you a penny. They are working for you. They're trying to help you find the home that you need. They know the market. They know what's available. They are experts. Use them. If anybody needs the name of an agent, ask me. Call me, text me, send me an email. I'd be very happy to give you a name of a great agent that I completely trust, that I know will help you out buying a home. Ask your parents, ask family, friends, good real estate agents, and most likely you'll get some names, and use them. As a buyer, you should use an agent. I shouldn't say you must, you should use an agent. Go to a lot of open houses. whenever they have them. Sometimes they have them on Saturdays and Sundays, sometimes even weeknights. Go to open homes, check them out, just get a feel for what floor plans you want. Do your research on neighborhoods you want to live in. If you've already got a job that you're really happy with, if you can find something close to where you work, that's even better, because the less time it takes to get to your job from your home, probably the happier you're going to be. Just that's less time you have to spend in your vehicle, more time you've got to do other things. So just things to keep in mind. So use websites like Trulia. The local agents, what they call multiple listing services. There's websites you can find with those. So agents will help you, your bank will help you, and so on. Okay. So Exhibit 511 in your chapter gives you some good strategies for home buying. So mortgages, I mentioned what a mortgage is. Basically, it's basically money you borrow to help you buy a home. The mortgage bankers fund your loan with the bank's money, and quite often they sell the loan. It's not unusual for your bank to sell the mortgage loan to somebody else at some point in the future. Mortgage brokers gather all the information that they need to make the lending decision, basically deciding do they want to take a risk on you, and they're going to look at a few years worth of tax returns, verify your income, look at your credit rating, find out what other debt you have, things like that, before they make the decision about how much loan to give you. And there's lots of companies that offer loans, so do your research on those too. Again, it's always good to ask family and friends who they used, but do some research. Go to websites. There's a lot of national companies that do loans. There's a good chance your local bank that you've been banking with will do a mortgage loan. Probably one of the best places to start is your local bank, because they know you. But don't be afraid to do your homework. You don't have to use your local bank. You can go to anywhere that'll give you a loan, but shop around. It's like shopping for anything, right? You want to find the best deal, so don't be afraid to shop around and do that. There's all kinds of different mortgages. There's what they call a fixed rate mortgage or an adjustable rate mortgage. I will tell you that you're probably best off going with some kind of a fixed rate mortgage. And it's okay to have a 30-year mortgage. There's nothing wrong with that. 15 years is great too. If you can afford a 15-year, by all means do it. However, if you take out a 30-year mortgage, you might be able to buy a little bit more home if that's important to you. There's no right or wrong to 15 versus 30. I will tell you that a great strategy with paying off a loan early is, if you do take out a 30-year loan, if you make one extra payment per year, you reduce 9 years off that loan. You'll bring it down to a 21-year loan. So just that's one thing to keep in mind too, that you can definitely bring those rates down if you need to, or those payments. So don't be afraid to make an extra payment if you take a 30-year loan. You can do that. Okay, so there's no penalty for early payment with these loans. Double check that. Ask your mortgage broker, is there a penalty for paying this off early? If there is, don't do it. Don't take that loan, because there's very, very, very many that do not have a penalty for early payment. You want to be able to make the early payment free of penalty. They have what they call ARMs, or adjustable rate mortgages, also, and those are mortgages where the rates are fixed for a certain amount of time, and then they might go up after a certain amount of time. So they might be lower for a few years. It says here 6 months to 5 years, and then they will go up at some point in the future. Sometimes they're based on some kind of an index. Sometimes they're tied to inflation. There's typically a cap at how much it can be, but typically you want to just lock into a fixed rate. Interest rates are very low right now. There's nothing wrong with doing that. Okay, so I would just suggest to you that's probably the way to go. It's just to lock into a fixed rate. Negative amortization, it says when the principal balance on a mortgage loan increases because monthly payment is lower than the amount of the monthly interest being charged. Some of them are subject to a undesirable condition called negative amortization. That's why, to me, an adjusted rate mortgage has more risk in it, based on how much the interest rate can change, and depending on what the value of your home is, that you probably just don't want to do that. I would just strongly suggest to you that you get a fixed rate mortgage. Now, there's lots of different types of mortgages. Conventional means typically just going through a bank. They assume all the risk of loss. There are programs based on your status, your income. If you are a first-time buyer, a lower income buyer, you may qualify for some federal programs that will help you, um, excuse me, that will help you get into a home. And they might, the FHA is one of the most popular ones, the Federal Housing Administration offers lenders mortgage insurance on loans having a high loan to value ratio to encourage home buyers to have very little money available for a down payment and closing cost. So just one thing to keep in mind, that an FHA loan might be a way to go. South Dakota has some, through the state of South Dakota, has some options too for first-time buyers, where they might be able to, they will potentially lend you some of that down payment, and you just make payments to the state to pay off your down payment once you're in the house, of course. So that's some options too. Then, of course, for if you're a veteran, the VA loan guarantee. There's some really good deals if you're a veteran or a surviving spouse of a veteran to get into a home mortgage also. That's guaranteed. Refinancing. If your rate drops, you should probably refinance. And there's a worksheet. I don't have it open because I'm not requiring it in Cengage. But it's out there in my.usf that you might want to consider to use to go ahead and refinance. So if your interest rates come down lower than your current fixed rate, you can refinance. There's nothing against doing that. And if you can do that and reduce your payments enough, you'll come out ahead eventually. There's closing costs when you do that. You have to pay some commissions and whatnot. But let's just say you're able to drop your payments by $200 a month, and maybe it costs you $2,000 to do that refinancing. Clearly it'll only take you 10 months to get your money back. It's probably worth doing, right? So just one thing to consider and think about when it comes to home mortgages. Now, right now, interest rates are so low, there's not a lot of refinancing going on, but potentially in the future, that might be something you would take advantage of.